Good morning, everybody, and welcome to the Reserve Bank to the release of our Financial Stability Report for May this year. The global economic and financial conditions do continue to pose some risks for the New Zealand financial system, but we note in this report that financial market sentiment has improved since the start of 2012. And this largely reflects policy developments in Europe that have helped mitigate the effects of the softening economic growth there and also of the stretched sovereign debt positions there, and in addition those European weak bank balance sheets. But we do note in the report that the situation does remain quite fragile given the limited progress that's been achieved in addressing Europe's underlying issues. In New Zealand, households remain cautious and they've been saving more, while business investment has been weak. Private sector indebtedness has declined, though this has largely been offset by an increase in public debt. Growth in most advanced economies still remains reasonably weak, and there have been recent signs of some slowing in Australia and in China. Commodity prices have eased off in recent months, which could create some financial pressures for some primary exporters if sustained. Thank you. I'd now like to hand over to Grant Spencer, Deputy Governor on the banking system.
Okay, well, looking at the financial system, the banks are travelling pretty well at present, considering the international volatility and low demand for credit. So non-performing loans are continuing to trend down and capital ratios are at pretty healthy levels. On the funding side, the international debt markets have freed up since the start of the year, although they remain very expensive. But because the continued flow of retail deposits has been strong and the weak demand for credit, the banks haven't actually needed to access that expensive funding. Indeed, all the banks are now meeting their core funding requirements by a comfortable margin, so we have confirmed that we're going ahead with the increase in the core funding, minimum core funding requirement from 70% to 75% in January next year. The Reserve Bank is continuing to strengthen bank regulation, in particular through the introduction of Basel III. We've recently reviewed submissions on the new capital adequacy standards and will shortly release modified proposals for further industry review. In fact, we're putting some information on that on our website today. In other areas, we're progressing a new legislative framework for covered bonds. We're continuing to work on the pre-positioning for open bank resolution. And in the insurance sector, we now have a provisional licensing regime in place, and 108 insurers are now licensed and able to conduct business in New Zealand.
Thanks, ladies and gentlemen. We're open for any questions.
Just in a speech that the Deputy Governor gave last week about macroprudential framework, you make reference there to developing a framework along with the Treasury to present with the Minister of Finance. How close are you to presenting that to the Minister of Finance?
The Minister of Finance has been kept in touch all the way through with the developments in macroprudential and indeed microprudential as well. So that's just an ongoing thing.
A time period?
Ongoing is ongoing. We're well advanced in most of the framework. Much of it's out in the public arena now. We're getting into some detailed stuff as time goes on.
There's been a bit of recent comment that perhaps the Reserve Bank's prudential oversight should be extended to cover KiwiSaver providers. Do you have any views on that?
Well, we at present KiwiSaver and other superannuation funds, managed funds, are covered by the FMA in terms of market conduct. That is, in terms of prospectus requirements, etc. And our view is that's the appropriate approach, and that prudential supervision of these funds is not required. In other words, we look at them pretty much as an investment in securities, where it's the investor beware, but the investor needs to be well informed and assured that the risk-return conditions or properties of the investment are represented in the information available. So prudential supervision, we're happy to leave it at market conduct approach under the FMA.
Is that simply because the prudential thing is more about the system as a whole, and KiwiSaver at the moment is just too small to be a factor in that?
Well, prudential is where you're looking at the financial institutions in the financial system and looking to assure that there are minimum standards of safety. In other words, a risk management or risk standards for those institutions and their balance sheets. When it comes to market investments, there's no reason why there should not be risky investments out there, and people can invest in risky investments as long as they know what they're letting themselves in for. So with a typical KiwiSaver investor, for example, you have the conservative option, middle of the road, risky. As long as it's very clear what those options are and the risk returns involved, then the investor should be allowed to make their choice. It's market conduct rather than prudential. Sorry, Barry.
So, Rob, yes, the answer is yes. Barry.
You probably haven't had a chance to do any formal analysis, but the presidential election in France with a socialist president doesn't appear to be keen on austerity measures, and then conclusive result in Greece. How concerning is that?
Well, I guess when we looked at the European scene through the last part of last year, we had to come to terms with the fact that there will be continuing periods of fragility and worry around Europe, and they are going to crop up and likely keep cropping up for the next while. And these are classic examples. So the markets are at the minute trying to understand what those elections might mean. We don't have an independent view of that. What we're more concerned about is, could it lead to any freezing up of bank funding markets in Europe, and we have to recognise there could be periods of fragility like that. So we'll wait and see where the markets come out on this, but it's certainly been a risk-off period over this last week or so because of France and Greece elections, and 2 weeks ago it was because of Spanish concerns around some of the Spanish numbers, and that's going to be, I think, the future for us for a little while.
If those markets froze again, would the Reserve Bank have to step in and offer the mechanisms it did in late 2008, early 2009, or have the banks got their funding needs and their core funding in place to handle it on their own?
We think the banks are in a pretty good funded position at the moment, but if we were to see a freezing up of European markets again, as has happened a couple of times now, then clearly after a while it does start to impact the banks on their lending and funding side. And we think we're in a pretty good position in terms of having demonstrated ability to step in with liquidity facilities if required. At the moment, there's no plan to do that.
Would it make sense, therefore, given there seems still to be a vulnerability to this hot money, to increase further their core funding ratio so that the banks could rely completely on term funding and on retail funding here?
Oh, I don't know what you mean about hot money. We're talking about medium-term funding markets here.
So essentially removing further the vulnerability to these medium-term notes?
We think we've got the core funding ratio calibrated about right, which is a requirement for domestic deposits and medium-term offshore funding to be at least to have got up to 75%.
To what extent at the moment is the adequate funding of the banks with they're above the 70%? To what extent is that simply the factor of the economic recovery taking a bit longer to get going than expected? And is there a risk of, as things do pick up, assuming they do, sometime out, then that's going to decrease somewhat?
I think the banks have organised their funding on an expectation of an improvement in credit growth, but of course that does depend on business and household sectors' demand. Partly that will depend on the housing sector as well. Certainly they're working on an expectation of growing their books, though, not contracting.
But I think that is right in the sense that, for example, if there are other investment opportunities, a lot of money is coming into retail deposits at present. If the market's picked up, you could have diversion of people's savings more into other investments, and that would tend to put pressure on the core funding ratio. So, through this period since the crisis, the core funding ratios have increased, a lot of it of its own accord, because the banks, were keen to build their precautionary balances, and retail deposits are flowing in. The key for our core funding requirement is that's when it may bite more, is when things pick up, pressures are on, retail funding flows are not as strong, and that's when the regulatory requirement will be more of a binding constraint. That's why we need to make sure it's there, because we want the prudential standards in terms of liquidity to be maintained through the strong part of the cycle as well as the weak part.
How concerned are you about farm debt in light of the big run-up that occurred in the last decade and the fact that commodity prices have come off quite a bit over the last year?
We're not especially concerned about it. We were a little more concerned a couple of years ago with that very big increase. We think both farmers and rural lenders have learned quite a lot from that about sensitivity to commodity prices. Over the last couple of years, there has been a chance for farms to reduce their debt. They've been doing that. With softer commodity prices, we'd expect that to show through in terms of caution in the farming sector and not particularly lead to concerns around debt servicing. But of course, that is sensitive to just what does happen on commodity prices. We don't see particularly exposed sectors out there now that we might have a couple of years ago.
Just looking at the March survey of credit lending standards, there seems to have been a significant easing of credit standards in the household lending sector and an expectation of an even bigger easing of those lending standards. Are you concerned at all about increased amount of 90% plus lending or large numbers of multiples to income lending that's going on in household lending?
No. We are seeing an easing of credit conditions, and certainly in terms of lending on housing, we're not concerned about seeing over-enthusiastic lending by banks at the minute, but we'll keep monitoring that. That obviously also depends on what happens in the housing sector. We're seeing some increase in house sales. We're seeing some increase in activity generally there. We had expected that. That's broadly in line with our forecasts. And we think that's probably a good thing rather than a bad thing for New Zealand. But absolutely, we'll keep looking at lending practices in that area.
In Australia, the parents of the big four banks here have acted not to pass on all of any cut in the official cash rate because they say their funding costs have increased. Would the banks be able to use the same reasoning not to pass on any change in the official cash rate here, given what you're saying about their profit levels and net interest margins in this report?
Well, Bernard, this isn't about monetary policy statement, of course, as you realise, but you did frame your question in a clever way. I don't know. How would you like to answer that?
Well, I would say that in New Zealand the pricing of the banks, mortgage pricing and other lending pricing, has always been it hasn't been in lockstep with official cash rate changes as it has been in the past in Australia. So always had these immediate shifts in Australia, and then when they started to go out of line, people were getting upset. Well, they've never been in line here, but mainly because one of the big factors is that a lot of the mortgages in New Zealand have been fixed rate mortgages rather than floating rate, so you haven't had this floating rate repricing being such a big deal. The pricing of the New Zealand banks goes off their cost of funds. An important driver of the cost of funds is the official cash rate, but there are other factors affecting it as well. And that's always been the case, and there's never been that sort of one-for-one mapping that you may have had in Australia.
But now that so many more people are on floating...
Sorry, just wait a second.
But now that so many more people are on floating rather than fixed, and your own figures show that the net interest margin has actually increased here, unlike in Australia, there would not seem to be room for them not to pass it on.
Oh, I mean, we're not trying to give signals to the banks here. We're expecting to be following competitive pressures in the industry. The demand for loans at the minute is not that strong. They're very aware of that, and they'd like to generally increase their lending, so they're under some pressure there.
Can you make any comment about the recent fall in the New Zealand dollar and whether there's the same need now to reassess the outlook for monetary policy settings that you indicated in the last cash rate review?
Well, we won't talk about monetary policy settings. We do obviously observe that the New Zealand dollar over the last week or two has been falling a bit, as has the Australian dollar. And that's presumably a response to a number of things, one of which is a risk-off environment in Europe, but also a recognition by the FX markets about our softer commodity prices and a few bits of softer data in Australia and New Zealand. So that's been moving in a direction that we would have thought is broadly in line with fundamentals.
Do you have any more news on Heartland and whether it might get a banking licence?
We won't, as you know, we'll never discuss individual institutions, Bernard.
Just looking at Basel III, you say you're putting some material on your website today. Have the banks been pushing back against whatever interpretations the Reserve Bank here has to the Basel III rules offshore?
Well, there's been quite a few submissions. We had a consultation document in November, then another one in March, and then the bank and other interested party submissions over the last few months. And yeah, a lot of them had concerns about various aspects of it, in particular asking questions where we deviated or had a standard that was somewhat different from the Basel standard or different from APRA. And so we've reviewed the submissions and we've made a number of changes to the proposals, taking into account those submissions. So some sort of valid arguments that we've recognised, and I think the banks will be interested to see in the piece that we've put on the website that we're probably moving back to some of our proposals to be more in line with APRA, although there's some differences still. I won't go into those here, fairly technical.
Thanks. Are there any other questions for us? Okay, thank you very much.